Imagine riding the absolute crest of this massive AI and data center wave.
Oh, yeah. The infrastructure boom.
Right. You watch a company's stock rocket almost 290% from its 52-week low.
Which is just wild.
I mean, it smashes through all these ceilings to hit $60 a share, and then the floor just completely gives out.
Yeah, massive reversal.
Exactly. It suddenly tumbles by over 26% in just the last 13 weeks. And today, looking at the latest price action, it's sitting at around $39.14, and it's down on the day.
It's the financial equivalent of whiplash. I mean, you
Right.
have this undeniable momentum driven by the broader AI narrative, right?
Oh, sure.
But then this sudden jarring halt leaves, well, basically everyone, institutional and retail money, wondering what they missed.
And that's exactly what we're unpacking today on Market Pulse Daily. We are looking at Viavi, and it's a deeply polarized situation.
Definitely. And before we get into the weeds, I want to quickly mention that for today's analysis, we are using StockOracle.
Yeah, StockOracle is this great AI-aided stock research platform we use for fundamentals, valuation estimates, moat analysis, bull and bear insights.
Right, comparisons, watch lists, portfolio research, all that good stuff. But of course, a quick disclaimer.
Always.
StockOracle is not financial advice, right? It's not a buy or sell recommendation or a trading signal service.
But it's not real-time market data either.
Exactly. Plus, AI insights and valuation estimates can be incomplete or just wrong. The
Right.
data might be delayed, so always verify the important facts yourself.
Always do your own research. And hey, if you want to check it out, there's a special 14-day trial link down in the description.
Just a heads up, that is an affiliate link, so the channel may earn a commission if you use it at absolutely no extra cost to you.
Right. So getting back to Viavi, the core contradiction here is it's wild. We were looking at a company boasting a 40% jump in annual revenue.
A huge jump.
Right. But the stock is completely stuck in this brutal correction phase.
Yeah.
So how does a company grow its top line by 40% in the middle of an AI boom, but leave the market feeling so incredibly anxious?
Well, to figure out that anxiety, we really have to look at the engine that drove the initial euphoria.
Okay, lay it out for us.
So Viavi's full fiscal year 2026 net revenue hit $1.52 billion.
Wow.
Right. And the sheer scale of that number is heavily anchored by their network and service enablement segment. That specific segment skyrocketed by 52.3%.
I mean, a 52% jump in a core segment is staggering. But we need to look under the hood of that revenue, right?
Definitely.
Because Viavi isn't designing the large language models. They aren't fabricating the GPU.
No, they're fundamentally in the business of network testing and measurement.
Right, which I always like to think of as, the building inspectors of the AI boom.
Oh, that's a great analogy.
Yeah. The hyperscalers are pouring billions into these massive data centers, right? But Viavi provides the specialized gear to validate that the physical plumbing can actually handle all that traffic.
And, that plumbing is getting exponentially more complex. The data highlights their heavy involvement in testing for 1.6T network speeds and co-packaged optics, or CPO.
Right. And that's not just basic stuff.
No, not at all. We aren't just talking about plugging in a fiber optic cable and running a basic ting test.
Right. Let's push on that technical aspect for a second.
Yeah.
Because co-packaged optics completely changes the architecture, doesn't it?
Oh, entirely. It brings the optics directly next to the switch silicon to reduce power consumption and latency.
And you just can't test that with legacy equipment.
You really can't. The physical proximity of the components and CPO means you are dealing with immense heat dissipation issues.
Right, things melting down.
Exactly. Plus, signal integrity challenges at the microscopic level and just the physics of moving photons faster than ever before.
So Viavi's equipment is basically there to validate that these bleeding-edge architectures won't melt or drop packets when they're running at full load.
Precisely. As AI models demand higher data throughput, the testing environment becomes radically more hostile, which means they need much higher margins, specialized testing suites.
Okay, which brings us to the Spirent acquisition. Because Viavi didn't just organically invent all of these capabilities overnight, did they?
No, they bought their way into a much larger footprint. By swallowing Spirent, they significantly broadened their portfolio into cloud and automated data center validation.
So they essentially bought immediate market share.
Right, market share and technological capability in the exact subsector that's seeing hyper growth right now.
But, looking at their broader revenue mix, the Spirent acquisition is running in parallel with their existing exposure to aerospace and defense.
Yeah, which is an interesting dynamic.
Right, because that aerospace and defense exposure always looks a bit like a pivot on paper. Like A network testing company suddenly dealing heavily with military contracts.
I know, it sounds random, but strategically, it actually serves as a massive countercyclical anchor for them.
How so?
Well, the tech sector's capital expenditures are notoriously cyclical. We all know the boom and bust rhythm of hyperscaler spending, right?
Oh, absolutely.
But defense operates on multi-year, locked-in government appropriations. It creates a stabilizing baseload for their revenue.
Ah, I see. So when commercial tech spending inevitably hits a, digestion period, those long-term defense contracts prevent the bottom from falling out.
Exactly. It provides a smoother revenue stream over the long haul, and that gives them the operational flexibility to make aggressive moves in the commercial space.
Like acquiring Spirent.
Exactly like that.
Okay, so on paper, we have a flawlessly executed strategy. They have the defense baseload. They integrate Spirent to dominate cloud validation. They are providing mission-critical testing for CPO, and revenue is sitting at $1.52 billion.
Sounds perfect, right?
Right, until you look at the bottom line. That 40% revenue jump is where the shiny narrative kind of crashes into the income statement.
Because buying another massive company is incredibly expensive, and the integration process leaves a huge crater in the short-term financials.
Yeah, the numbers show a really jarring split personality in their accounting. So despite pulling in $1.52 billion on the top line, Viavi reported a full-year GAAP net loss of $30.4 million.
Which is a deterioration of 187.4% year over year.
Right. But while that's happening, management is pointing to a non-GAAP EPS jump of over 161%.
And they're boasting about 24% operating margins in the fourth quarter.
Okay, this is where we really have to separate the signal from the noise for everyone listening, because it is so easy for management teams to point to non-GAAP metrics and say, hey, ignore the massive hole in the balance sheet, look at our operating margins.
Oh, they do it all the time.
Right, but that $30.4 million GAAP loss, that is real cash leaving the building.
It is real cash, but it's tied to the friction of the Spirent acquisition, not necessarily a failure of the core product lines.
Okay, break that down for us.
So the non-GAAP numbers, like that 24% margin, reflect the healthy daily operations of selling testing equipment to hyperscalers and the military.
Right, the actual day-to-day business.
Exactly. But the GAAP losses capture the unvarnished reality of restructuring charges. We're talking severances for redundant workforces and massive earn-out payments related to swallowing Spirent.
Those earnouts are a huge mechanic here.
Huge. If Spirent hits specific performance milestones post-acquisition, Viavi is contractually obligated to pay out additional cash.
So, ironically, if the acquired business performs well in the short term, it actually drives GAAP net income further into the red.
Yes. Because of those contingent liabilities triggering, it creates this fascinating paradox where operational success exacerbates short-term accounting pain.
Like doing a massive home renovation.
That's a perfect way to put it. The core structure is sound, the property value is going up, but right now your bank account is draining to pay the contractors.
And Wall Street, predictably, hates that transition period.
They absolutely hate muddy waters. With trailing EPS sitting at negative 25 cents, institutional money just cannot confidently run their discounted cash flow models.
This because they're stuck trying to model out when these integration costs will finally sunset.
Exactly. And that uncertainty bleeds directly into how the stock is priced today. Even after the severe 26% pullback down to the $39 range, the valuation metrics are still pretty aggressive.
Yeah, I mean, you were looking at a price-to-sales ratio of 7.6 and a price-to-book ratio of 12.3.
And a 7.6 price-to-sales multiple for a hardware testing company that is pushing into SaaS territory.
Right, you usually only see those multiples when software margins are fully baked in. Paying over 7 times revenue for an entity currently posting a GAAP net loss requires, well, an enormous amount of faith.
Faith that the analyst community is completely divided on. The dispersion in the price targets right now is highly unusual for a company of this size.
Yeah, I saw that. UBS slashed their price target all the way down from $60 to $44, stamping it with a neutral rating.
Which means they're clearly looking at those GAAP losses and that elevated price-to-sales multiple, and they're demanding proof of execution.
But then Stifel's looking at the exact same data and raising their target to $65.
Right. And B. Riley and Needham are maintaining buy ratings, though they slightly trimmed their targets to 60.
So you have a $21 spread between major desks on a $39 stock.
Which basically means their terminal growth assumptions are in completely different universes.
Okay, so what are the bulls seeing that the bears aren't?
Well, the bulls at Stiefel are heavily weighting the AI infrastructure capex. They're assuming the Sparent integration finishes seamlessly, the earnouts roll off, and Viavi captures massive margin expansion on CPO testing.
Got it. And the bears.
The bears at UBS are modeling in extended integration friction. And, they're questioning whether the hyperscaler capex might decelerate before Viavi can fully capitalize on it.
When you have that kind of ideological battle on Wall Street, I always like to look at what the people inside the building are doing with their own money.
Oh, insider trading is always telling.
Right. And the insider trading logs over the last 90 days show 4 sells versus only 2 buys. That nets out to minus 3,975 shares.
Now, the absolute volume under 4,000 shares isn't a massive capitulation for a billion-dollar market cap.
True, it's not a panic sell-off by the C-suite.
Yeah.
But the ratio of sellers to buyers is a consistent, mildly bearish signal.
Definitely. I mean, if you are an executive watching the Spirent integration from the inside and you see the stock touch $60 while the GAAP losses are piling up.
Trimming your position is just a logical risk-off move.
Exactly. It suggests they felt the valuation got ahead of the actual earnings power during that massive AI rally.
It really reinforces the cautious sentiment. The insiders are securing some liquidity while the company navigates this expensive digestion period.
Right. And the ultimate question for anyone looking at this stock is the timeline. When does the digestion end?
And do they have the balance sheet strength to absorb the cash burn until then?
Well, let's run the numbers on that liquidity. Because the balance sheet shows $656.7 million in total cash and short-term investments.
Which looks like a formidable war chest.
It does, but it's heavily offset by $641.9 million in net debt carrying value.
So they're running a highly leveraged capital structure to fund this growth.
Yes. And the cash flow generation to service that structure has been wildly variable. Earlier in the year, they actually burned $26.3 million in operating cash flow.
Mostly driven by the variable compensation and acquisition costs we detailed earlier.
Yeah, exactly. Now, they did manage to turn it around in Q4, generating $66.7 million in positive cash flow.
But relying on that variability when you have over $600 million in debt hanging over the operation, that's a tightrope walk.
It is.
And I really want to dig into the specific mechanics of that debt structure because there is a massive catalyst lurking in there. They have $400 million in standard senior notes, but they also have $250 million wrapped up in 0.625% convertible notes.
And honestly, that 0.625% interest rate is phenomenal for their current borrowing costs.
Yeah, it's essentially free money in the current macroeconomic environment.
It is free money.
Yeah.
Right up until it isn't.
Exactly. The mechanism of a convertible note is always a double-edged sword. If the stock price rockets past the conversion strike, those note holders convert their debt into equity.
Which immediately dilutes the existing shareholder base.
Right. But given the recent pullback to $39, the opposite risk is suddenly in play.
The refinancing risk.
Yeah.
Because if the stock languishes and doesn't hit that conversion threshold, those note holders are going to want their $250 million back in cash at maturity.
And if Viavi doesn't have the free cash flow to pay them off, they have to refinance that $250 million.
Right, and replacing a 0.625% note with new debt in today's interest rate environment, say at 5 or 6%.
Oh man, that would cause their interest expense to explode. It would permanently drag down their future EPS.
That impending maturity wall adds immense pressure to the timeline. They have to prove the Spirent acquisition was worth the leverage before those notes force their hand.
Which isolates November 2026 as the ultimate proving ground. Q1 FY 2027 earnings.
Yep. All eyes on November. Management has already laid down the marker, guiding for $450 to $460 million in net revenue and a non-GAAP EPS of 40 to 42 cents.
Hitting that guidance would show continued sequential growth. And from a technical trading standpoint, the stock really needs to reclaim that $45 level on high volume to invalidate this current downtrend.
That's where it broke down in late July, yeah.
But fundamentally, is hitting that non-GAAP EPS guidance enough to change the narrative?
Honestly, no. Relying on non-GAAP metrics won't satisfy the institutional money anymore. To truly capitalize on the secular tailwinds and justify a 7.6 price-to-sales multiple, Viavi must report positive GAAP net income.
So they have to demonstrate on paper that the massive integration charges, the severances, and the earnouts are definitively rolling off.
Exactly. They need to prove the renovation is over, the contractors are gone, and the house is actually generating net cash.
And if they flip to positive GAAP earnings, it forces the bears to reevaluate their entire model.
Right. It allows analysts to value the company on a standard price-to-earnings framework based on forward cash flows rather than penalizing them for transition costs.
The AI infrastructure build-out is real. The demand for 1.6T testing is accelerating, but the market demands clean execution.
The November print is basically binary. Either the operating leverage finally kicks in or the debt concerns start to overshadow the revenue growth entirely.
It's the ultimate lesson for anyone analyzing companies scaling through massive acquisitions. You can never just take the top-line revenue at face value.
No, never. Buying a competitor to acquire top-line growth is the easy part. Digging through the GAAP net income and operating cash flows will show you the brutal, unvarnished cost of that growth.
Integrating a massive acquisition profitably requires surgical precision, and capital markets rarely offer the benefit of the doubt during the mess and middle of that process.
They definitely don't.
Now, before we close out today's Market Pulse, there's one final, broader question we need to consider. A thought experiment for you to take away.
Let's hear it.
We've established that Viavi is positioned as the elite building inspector for the hyperscalers. Their near-term valuation heavily relies on this relentless AI capital expenditure cycle. But we know tech infrastructure moves in cycles.
It always does.
Right. So what happens if the AI spending bubble pumps? Or even simply decelerates to a more historical growth rate?
That forces a critical reevaluation of their position in the tech stack.
Exactly. If Amazon, Google, and Microsoft suddenly mandate a 10% cut in their infrastructure capex, are the network testing contracts the first things to get slashed? Or is testing 1.6T environments so difficult and so prone to failure without third-party validation that Viavi's equipment is completely insulated from those budget cuts?
Right. It's the difference between being a discretionary luxury and a mandatory utility.
And whether they are viewed as a luxury or a utility will dictate how hard they fall if the macro environment shifts. Because a stock can easily climb 290% on a narrative, but the gravity of actual GAAP fundamentals will always drag it back down to earth.
Let the math, not the momentum, guide your analysis.
Well said. And a quick reminder, if you want to run these kinds of fundamental numbers yourself, check out StockOracle. The link for a 14-day trial is in the description. Again, it is an affiliate link, so it helps support the show if you use it.
But as always, remember that AI insights aren't flawless, and this isn't financial advice.
Exactly. Thanks for tuning in to Market Pulse Daily. We'll catch you on the next one.